So you probably heard about stocks, bonds, and maybe even gold, as we mentioned in our previous video. But what about managed futures? This strategy has been long used by hedge funds and institutional investors to reduce risk. And now it's finally available to the rest of us, to mere mortals like you and me, through ETFs. So in this video, I will explain what managed futures are, how they fit into a diversified portfolio, and which ETFs I personally use. So let's get into it. At its core, managed futures is a sort of a rule-based strategy that goes long or short on futures contracts across things like commodities, currencies, bonds, and also indices, depending on trends. Think of it like a professional algorithm that trades based on momentum signals and not emotions, like other people usually do. The idea is to profit where markets trend up or down, especially useful when stocks and bonds are both struggling, which has been the case in the past for many times. Here's where it gets interesting. Managed futures tend to be uncorrelated to stocks and bonds. And you know I love uncorrelated assets. In fact, they often perform best during chaotic or crisis periods when traditional portfolios are actually struggling. So if you want to take a look at my uncorrelated portfolio or my portfolio of uncorrelated assets, take a look at the video down below in the comment section where I actually use managed futures. I incorporate them in my portfolio. So by adding them, you can, first of all, reduce drawdowns, which we all love, lower overall volatility, which is great, and improve risk-adjusted returns, which is a higher Sharpe ratio. So I think you will have to leave a little bit of the gains behind, but I think it's worth the increase or the lower in the overall volatility. So they are like the ballast in your ship when the storm hits. This used to be the domain of institutional hedge funds, but now there are ETFs doing it with daily liquidity and lower fees, which is great. Some of the best known ETFs or managed future ETFs are the following. So first of all, there is KMLM, which I will use in my comparison later on. There's also DBMF and also CTA, which I'm starting to use now as part of my portfolio too. So let me show you the results in Portfolio Visualizer. I'll show you the portfolios that I built. As you can see here, I have two portfolios. The first one is the classic 60-40 portfolio, which 60% has 60% SPY and 40% TLT, which has been beaten pretty bad in the last few years anyway. And the second portfolio that I have is the 60-20-20, which has 60% SPY, 20% TLT, and 20% KMLM, which is the ETF that I used for this. So let me show you the results. Let's jump into the chart. Obviously, the S&P 500 in the last, take into consideration that KMLM has been around only for 4 years, since January 2021, a little bit more than 4 years. And obviously, the S&P 500 has been the clear winner when it comes to overall performance. But the interesting comparison here is the comparison between the 60-40 portfolio and the 60-20-20 portfolio. We know that the Magnificent Seven have been, very difficult to beat in the last few years. So I wouldn't expect that to, continue in the future. And actually, we're seeing a pretty dramatic drawdown in the last few months or weeks. And again, interesting comparison is the comparison between the 60-20-20 and the 60-40. Let's take a look at the results and the data, which I have over here. So as you can see, the annualized return for the 60-40 portfolio during that time frame was 3.2%. For the managed futures strategy or 60-20-20 was 7%, so clearly more than double the 60-40 portfolio. And in terms of performance, the S&P 500 has been the clear winner with 11.5%. Interesting to see the worst year and the maximum drawdown. So worst year and maximum drawdown for S60-40 portfolio was 23 and 26 respectively. And the 60-20-20 was only 11% for both, 11.08 and 11.39. So yeah, and the case of the S&P 500, that was the minus 18% for the worst year and minus 24% for the maximum drawdown. So clearly the Sharpe ratio and the Sortino ratio much better in the 60-20-20 portfolio. And I also anticipate that in future years where there's no this overheating of the Magnificent Seven and there is more regular returns for the S&P 500, I think the 60-20-20 might be able to beat the S&P 500 in terms of risk-adjusted returns. If we take a look at the maximum drawdown, let's take a look at the chart here. For the maximum drawdown for the three portfolios, we can see that clearly the winner here is the 60-20-20, including the managed features with KMLM. And you can see, again, minus 11% when compared to the 60-40 portfolio, which was minus 26%, and the S&P 500 minus 24%. If we look at recent weeks, unfortunately, only Portfolio Visualizer only shows until 31st of March. So it will be interesting to see the results during April, which we had pretty dramatic drawdowns. And but still here we can see that the 60-20-20 had the better results, very similar to the 60-40, about 4.3%, and the S&P 500 was minus 6.7%. Okay, if we just make some adjustments and we include here the data for the DBMF, so I will just make a change and include DBMF in replacement of KMLM, and we analyze the portfolios. So that spans over 5 years, one more year than KMLM. That shows similar results in terms of, better results in terms of performance for the 60-20-20, also as well for the 60-40. And the worst year and the maximum drawdown features of the KMLM managed features portfolio are still displayed here. Minus 12% worst year for the 60-20-20 portfolio, and minus 23 and minus 18 respectively for the 60-40 and S&P 500. The maximum drawdown was minus 26 for the 60-40, minus 24 for the S&P 500, and only minus 13 for the managed features, including DBMF. In the chart, again, you can see better results for the S&P 500 in the last 5 years, and better risk-adjusted returns for the managed features portfolio. Let's take a look at the drawdowns here. If we go to the drawdowns chart, again, much better results, much better behavior of the managed features. Even before that, actually in 2020, the 60-40 portfolio showed better results in terms of maximum drawdown. It was minus 5% for the 60-40 and minus 8.76 for the managed features portfolio, but minus 20% for the S&P 500 during March 2020. So things you need to know that this isn't a magic bullet, okay? There is a few important points. The first one is that they can underperform for years where markets are sideways, okay? This is very important because they are, trend followers. So if the market is sideways, you can have, underperformance. Returns can be volatile depending on the trend strength as well, related to the other comment that I made. And the strategies can differ quite a lot across different ETFs. So you need to know what you're buying, okay? Let's take a look at the documentation and get to know what you're buying. But overall, when paired with other uncorrelated assets like gold, dividend ETFs, or bonds, they can offer an incredible portfolio resilience, okay? So if you're serious about building a resilient portfolio, not just chasing returns, managed features, I think they deserve a closer look. Let me know in the comments if you want a deep dive into the ETFs or a full portfolio build with managed features included with more analysis. But overall, like and subscribe and hit the bell button if you're into smarter investing strategies. Thank you very much and see you in the next video.